Hi, everyone. Welcome to FinTech Unleashed. Payments innovation is accelerating dramatically, and it now sits at the heart of how banks and credit unions build lasting relationships with their customers and members. My name is Virginia Heyburn. I'm the Director of Research, Insights, and Advocacy at Engage FI. And today I'm really excited to be joined by my colleague, Andrea Rusnak, our Director of Payments, for what I'm sure will be an exciting conversation on emerging payments trends. We're going to chat about how the payments landscape is shifting, about new payments capabilities our industry needs to be ready for, and also what action banks and credit unions can take to offer customers and members a really satisfying payments experience. So let's jump right in. When it comes to payments, consumers want speed, they want ease, they want convenience. Anything less than that is quickly becoming a reason to go find another bank or credit union. So any payments innovation conversation has to be actionable for smaller financial institutions and their strategic planning just as much as it has to for larger institutions. So Andrea, I want to start this conversation with the elephant in the room, and that is the size differential. The large banks have those deep pockets to invest heavily in new payments technologies and in so doing change with the times. But how can community banks and credit unions achieve a future ready payment strategy? I'll turn this over to you.
Thank you for having me, Virginia. It's great to be here today and with all of you. I would say that whether you're a small institution or a large institution, it starts with having that payment strategy and that focus and knowing what is important to either the clients that you serve or the members that you serve. And so, one of the things that we can all do well, whether we're a large institution or small, is making sure that those customer experiences or member experiences are seamless. So, you talked about that a little bit earlier about no matter what channel that those folks are coming through, whether it's through online banking, whether it's through mobile, whether it's through chat or in a branch, you want that experience every time to be frictionless, easy, convenient, so that there's no chance that they pick another institution because they don't feel like their needs are being met. And so that's not even just a technology focus, that's really a customer experience focus. And so what I like to tell the clients that we're working with is make sure that all the options that you offer are ones that are going to serve your membership or your client base the best. And it's things that are going to actually help within their financial services lives and their needs.
You know, as you said that, Andrea, I can't help but think of the discussion around payments hubs that we've had all these years, right? You know, one of the points of guidance that I give community banks and credit unions when it comes to payment strategy is to really think about payments from an enterprise standpoint, have an enterprise payment strategy, and think about payments hubs as a central place where payments of all types can be managed and where, importantly, innovation can be driven because payment rails are starting to shift, right? We're starting to see some considerable bumps in payments volume depending on the payment type. Do you have a thought on that?
Absolutely. You're 100% right on that. I mean, one of the things that we saw during the pandemic is really the shift to that experience being online, right? Because we weren't going out, we weren't shopping in person at those merchants, we were doing everything online. And so having those mobile wallets available and those stored value cards available to your client base was really important because we knew those transactions still had to happen, but they had to happen in different forms. So it really pushed the narrative and the discussion and the trend that people were using their cards in a totally different manner than they had previously. And it was becoming not just we're ordering through Amazon, but we're doing Uber Eats, we're doing Uber delivery. We're looking at really different ways to make sure that our needs are still being met, whether it's through Instacart to have those groceries delivered. So it's making sure that your client base understands what's available to them. They can still transact. It might just be in a different way. So giving them some educational pieces on that and how easy it is to use and right back to that convenience factor is key.
And for smaller financial institutions, it's not just a consideration of payment type, right? It's security. It's, you know, how do you manage risk in a rapidly evolving payments world?
Absolutely. And I think that's always, we call it the risk and the reward, right? You always want that card to be used. So it's kind of that looking at the trends of what's that false positive ratio, but it's also about what that experience is. So what's your respective institution's financial tolerance on the risk and the reward? Kind of comes back to the overall, what's the relationship banking that you have with your clients or your members? understanding their needs and realizing this is within their normal pattern of behavior. So we want to go ahead and approve those transactions. And if strategies need to change, it's having that agility and flexibility within your institution to understand what needs to be changed for that customer or for that member.
And I know we'll come back to this conversation throughout. How do we make an innovative payment strategy actionable for smaller institutions? Because frankly, they're going to have it if they're going to survive. But I want to touch next on one of the big topics in payments right now, and that's the launch of FedNow, recently launched, of course, for instant payments. In your mind, what benefits will FedNow bring to community banks and credit unions, and by extension, of course, their customers and members?
Absolutely. It's the biggest topic right now because it just launched end of July 20th. FedNow came out with this new real-time secure payment, 24/7, transactions clearing. That's a big deal. We haven't necessarily seen an option like that through the federal government in over 30 years. So this is something that the industry's really been taking note of. The early stats and trends that we're seeing, there's about 47 early adopters that were part of that pilot program, both from credit unions and some banks and also some processors. And why that's important is that it's back to that we want to make sure that channel is coming through in a very timely, real-time fashion. We are all so used to the now factor. And so that goes right in line with making sure those transactions are securely flowing. They're in a real-time manner, makes it easy for that P2P strategy. And it also helps with businesses as well that are looking to leverage that channel for their small business as well.
And I'm glad you brought that up because I was looking at a recent Federal Reserve study that showed that nearly 2/3 of businesses indicate they would consider access to faster payments a reason to switch a financial institution.
Right. It's huge. It's definitely a factor in when they're looking at which financial institution is there going to be their institution of choice. So it kind of goes back to our earlier discussion about small versus large. You don't necessarily have to have every solution, but you have to be agile enough to know what your market, what you're serving, and what might be missing, and to make sure you're meeting the needs of the base that you're working with.
And that also raises the question around what's it all going to mean to other payment types. And I've seen quite a bit of debate in our industry about how FedNow may, really threaten Venmo or Zelle. I think there's a big difference between FedNow and Venmo or Zelle in that, FedNow is a payment rail, Venmo and Zelle are effectively payment applications. So there's a really big difference. And FedNow also is not just limited to P2P. In fact, it's just so much more than that. So many different payment types, whether it's, capability for disbursements or to get paid faster, get your payroll faster, making that so much easier. What are your thoughts on this?
I would agree with you, Virginia. I think your assessment is really good. I think it's still really early to tell, right? This new product through FedNow just launched last month. So we'll see in the next several months what's the traction, because the Federal Reserve is saying that they expect 9,000 credit unions and banks to take advantage of it. There's only, so many that are live today because it's so new and it's new technology. But I agree with you. I think from a consumer point of view, we're used to having in our phones that easy application, whether it's Cash App, whether it's Venmo, whether it's Zelle, and transferring that money after we have dinner with multiple friends. And we don't want to split the check when we're with the server, right? We just want to send that money instantly. We're used to doing that. That's kind of the common part of, our consumer business and preferences. So I agree with you. I feel like FedNow is going to be another payment rail and a really interesting channel to watch to see what the adoption looks like and to see how much it's able to serve small businesses and other communities as well.
Totally. And, when I go around to banking conventions, conferences, meet with clients, I'm sure you're hearing the same thing. There's a lot of interest, a lot of enthusiasm, because it's a long time coming. In other countries, of course, we've had real-time payment rails for a very long time.
Right. I would agree with you. That seems to be the hottest topic. I had a conversation last week with a Bankers Association group. And when I asked, towards the end, what questions that they had, everyone was talking about FedNow. They said, this is top of mind. We're thinking about it. We're looking at it. We may not want to be the ones that are the early adopters for it, but we definitely know what's happening. And it's definitely going to be something as it evolves. It also will possibly impact their payment strategy within their organization as well.
Speaking of other countries, when I was in Spain just over the summer, I went to a grocery store, Andrea, and literally everybody in front of me, there must have been 8 people in line. They all whipped out their mobile phone and they paid with their mobile phone. And there I was, the 9th person, getting my physical card out. I almost felt embarrassed Do you foresee a time in the not too distant future where we're paying this way in the United States?
I don't think, we are not always as quick in the US as adopting trends in other countries, as I've seen, as I've traveled internationally as well. We tend to take this approach of let's see it, see what happens, and then we take it. I do think that as preferences change and as the Gen Zers come up and they're the ones that are really driving more, currency through our environment, that people want that freedom. I mean, I know when I was on business travel last week, I'm getting gas in the rental car. I'm using, my phone. I'm using that contactless card. I really did not interact with anyone until the end of my stay. I mean, even my hotel key was on my mobile phone. I was able to digitally say, this is the room I want. It's available. It charged my card, got my preferences. I mean, it was such an easy way to say, I don't have a lot of time to check in with the front desk as much as I would love to say hello. I need to get in there, get ready for my meeting and get on with my day. And so that for me was it was so much easier to just know everything I can use in my phone. It's my card device. It's my technology. It's not, I joke with some of my colleagues, our phone is almost, we don't even use it to call anymore, right? We're using it for text, we're using it for Teams, we're using it for Zoom. It's become just the device for everything. And I think in the future, we're going to see that shift in the United States as well.
And it's not just consumers. Consumers are pushing our industry. It's merchants. The merchant acceptance
Absolutely.
piece is obviously huge.
I agree with you. Merchants definitely drive our adoption, right? They can choose our preference, contactless and tap to go. We're definitely part of merchants pushing that, channel for us.
Sure. And, I do think that payments in the online channel are influencing our expectations in the physical channel as well. The fact that payments are happening behind the scenes. You mentioned Uber. You also Apple Pay, right? It's so easy to make payments anywhere through PayPal. And then you get to the point of sale and it's just, there's so much friction involved and it's so painful. It's become so obvious. So definitely quite a few problems that we do need to solve. Apple Pay's been pretty successful, right?
Yes.
And just another example that I think of, quite often, once you discover that you can do it more simply, you can do it somewhere. You want to do it everywhere in that way.
Exactly.
Who wants to enter a password anymore, right? Biometrics. We just, face recognition, thumbprint. Nobody wants to enter in payment information. It's become so tedious.
And I can think of a good example. Last week I was on a plane ride and I had a long plane ride and I thought, I need to purchase Wi-Fi for this flight. I don't want to pull out my card that's buried in my bag. I just want to do it. So I just literally pulled up my cell phone, did Apple Pay. It was instant, connected me right away. I'm on the internet on my phone. I didn't even have to pull my card out of my wallet. And that, like you said, it was convenience. It was easy. I'm going to do that every single time because why do I want to take the time to enter that information? Or like you said, if you're at a merchant, I don't want to be the one that's holding up the line because I don't have, tap to pay on my card and I can just easily go through the line and be done. So for me, it's fast and seamless and that secure experience is what I'm looking for.
Yeah. Social pressure is forcing us to have a better way to pay.
Absolutely.
You mentioned the car, and this is an area that I find fascinating. I've been doing some research in vehicle payments for both consumers and businesses, right? So imagine you spend an hour a day in your car. I think that's the average according to AAA. There are so many payments associated with either having a car or being in the car. And the obvious payments are going to be, you mentioned it, gas,
right,
tolls, parking fees. But then you think bigger, you think car washes, you think the Chick-fil-A line. I'm, driving through, picking up some food, picking up groceries. So many of us pre-order things, we pick them up. What about repairs? What about oil changes? The list goes on and on. In the future, it could be, I'm on a road trip. Let me look for a hotel, make a reservation, and just go ahead and pay for that. There, by some accounts, up to 20% of consumer payments could conceivably be made through a car. So it's fascinating to see how this whole discussion around what constitutes a digital channel is shifting. Imagine a world where you really didn't have to whip out that physical card to make those types of payments, effectively eliminating friction, whatever friction still remains in a very short period of time. The car manufacturers are investing in this, the payments companies, Visa, MasterCard, everybody's getting into this game after a little bit of a hold during the pandemic.
Well, it goes back to that personalization, right? Because if you're getting those notifications that, in the next mile, they can see you've rented the car and you're going to turn it in for gas. They're going to give you some options of, here's some, fast food restaurants you may want to stop through. It
Yeah.
kind of goes back to knowing your customer and knowing what's important to them. So getting those personalized offers in the car, most people, if they see those, are going to say, oh my gosh, that I was already going to go to Starbucks, but now I already have that app stored. I can get my coffee. I can return this car. I can get gas, and it knows who I am, and I don't have to pull my card out. How convenient and easy is that? Whether you're on a road trip just for personal with your family or your business traveler, you're making it so easy to want for me to do business with you. And you make it so easy if my financial institution's information is already stored.
Absolutely. And, the big banks are making moves. JP Morgan bought 75% of Volkswagen payments back in 2021. Small banks have to stay in the game. Credit unions have to stay in the game because they have to keep their card in the middle of all of these transactions. And that's not a small challenge.
No, and I think that goes back to, really understanding the providers that you work with in collaboration, because even though you might be the small institution that financially can't come up with a new strategy or solution yourself, the providers that you work with also offer tools and solutions that you can take advantage of. So it's really understanding what's available to you and asking the right questions and say, this is what our strategy is for the next 2 to 3 years or longer. What can you offer us today that will serve either our client base or our membership base? What is something that we can take advantage of today that's already off the shelf and that we can roll out in a quick and fast manner?
And that's, I think, such an important point you're making. And it really goes to that opening question around the elephant in the room, right? The community banks, the credit unions, they are in so many respects, depending on their primary technology providers, their primary partners, to help them with the innovation that's necessary. But if you look back historically, those technology providers and partners aren't necessarily, could never have been accused of being on the leading edge of technology. Let's put it that way.
Sure.
So that has to shift, right? So the core providers, the payments providers, they really have to guide smaller institutions into this new world. And then another point, something I was thinking about, I'd love your opinion on. In the old world, you might have, a 5-year or a 7-year contract, and you'd kind of push off innovation until your renewal period came along. The banks and credit unions, they really can't afford to do that anymore, can they?
No, I think the thought of just set it and forget it, we're way past that, right? We have seen so much advance, not even just in the payment space, but in technology and honestly what folks are looking for. And so I always like to talk to clients when we're looking at what's your strategy. I rarely hear any more 5-year strategy because things evolve and change so much. I'm hearing 1 to 3 year strategy. And it's really understanding if you haven't done some vendor due diligence review and you haven't looked at the landscape in the last 5 to 7 years since your contract was up, that's where you hire the right consultants to come in and say, objectively, here's what we're seeing with other clients. Here's what's happening in the market. Here's what other institutions are doing. Here's the things that we're seeing from, folks like Visa, MasterCard, and others that are in the space, and really educating on them on what's available and what they may not be leveraging. I think a common thing that's come up in the last several months with clients we've been working with is just the conversation around, is the technology that you use, is that all outsourced? Are you using, interfaces to that? Or is that something that your IT team is working on internally, meaning they're using those APIs and they're consuming that data, they're building out their business intelligence, their data warehouses, and really leveraging that type of data for their CRM system so they know, this is what our customers are doing or what our members are doing. We should be putting solutions forward that is addressing what the market needs are for our customer base.
And it is a hiring challenge to find the right people to handle this kind of innovation, both internally. Banks and credit unions are going to have to bring people in, but in my view, looking at primary technology providers, it's never been more important to meet the bench, right? What I mean by that is if payments innovation around, let's say, in-vehicle payments or payments innovation around embedded payments mobile payments is a strategy, then you need to know that the technology providers that you're partnering with actually have people in their organizations that are making that happen. So meeting the bench, confirming that the resources are there to support the kind of innovation that you need to affect.
I totally agree with you, Virginia. And I think that one of the key things that we ask in RFPs and other things when working with other providers is, what is your 12 to 24 month and on roadmap? What have you delivered in the last 24 months? What technology have you used? Are you in a waterfall environment? Are you in an agile environment? And what is your focus on your research and development dollars? Because that usually will tell you pretty quickly how focused is the organization as a whole on their people development, their strategy, their technology. and making sure it's delivering that seamless client experience every single time.
Absolutely. We talked a little bit about younger consumers driving some of these expectations. Generation Z, they're certainly
Mhm.
sending a really clear signal that they want to pay in different ways. What are the biggest differences do you see in how Generation Z views payments versus other generations?
So the Generation Z are the ones that are always online. They're the ones using the channels that maybe nobody's even tried yet. There's the ones that were doing the Cash App before it was even a thing. They were the ones trying to find ways to make payments as easy as possible. They're also the ones that are in the workforce. There's 58 million of them today. That are the next ones that we need to target for the first time car loan, paying off the student loan, their secured credit card. They're going to establish credit. Those are the ones that could be going into the tech field, making those large salaries and may not have that financial awareness yet of what do we need to balance what we're taking in with what we're spending and what our expenses are. And those are the ones that we have the most opportunity with to bring them in while they're just starting out, build that foundation, that key layer with them. And as their lives evolve and change, we can grow our solutions and products for them. If they're not able to, we call it in 3 clicks or less. If they're not able to get online really quickly and get what they need in an immediate fashion and it doesn't recognize them and know what they're looking for, they're going to go somewhere else. So whether that's in person or online through a mobile channel or even through a laptop or an iPad, they expect that immediacy and they expect the result to be consistent every time. If they don't get it, they're the first ones to go shop someone else that will give them that experience.
Yeah, and they're the first ones to teach the rest of us in other generations that there's a better way to pay, right? So
Absolutely.
reverse mentoring. And that's a little bit of a concern when I look at the industry is that other generations are learning from Generation Z that there are more modern ways to pay instead of from the financial services industry. So I really think that there is a need for banks and credit unions to educate their customers and members on the kind of innovation that they are bringing to them, why it is important, what they get out of it.
Absolutely. It's kind of goes back to, if you open a checking account today, how many people are actually going into a physical branch to do that? Most folks are doing that online, right? They're doing that digital account opening. And if you told a Gen Zer how to balance a checkbook, they would be like, what is a checkbook, right? That's a generational huge difference. That's not something they're looking at. They're looking at their mobile phone to see their last 5 or 10 transactions. They're looking to see if they have a fraud alert, looking to see what's available to make a payment. It's such a difference in dynamic and what we have to serve. But at the
Mm-hmm.
end of the day, it's all about financial integrity and financial wellness. They have to have a strong feeling that you know them, you know what their preferences are. You're going to prevent, fraud on their account. You're also going to let them know when there's offers that should be something they should consider. Kind of goes back to that financial and wellness is understanding what you need to offer that particular client or member.
Yes, absolutely. And, this is really where artificial intelligence,
Yes.
generative artificial intelligence comes into play. We've been talking about the need for decades, really, to transform traditional bank and credit union channels into sales channels, to know the customer or member, to give them the right offers, to help them navigate their financial lives. Artificial intelligence on top of open banking technologies, innovative payment technologies and capabilities. That's really what helps us make that happen.
Absolutely agree. It's also about thinking about the instant credit decisioning, right? That someone might have come in for initially different products or service, but you already know them. You've already done that, pull on their credit or a soft pull on their credit. And this person can qualify for a larger line on their line of credit or on their credit card and making sure it's timely because if you're not doing it, guaranteed some of the larger financial institutions are doing it.
And another data point I find so fascinating about Generation Z, we've come from 10 years of unbundling financial services, right? Where a fintech would carve out a slice of banking and they would run with that. A payments company would do the same, and over here, an online lender. But what Generation Z is telling us is, I want it to be simple. I want one place to go, ideally, to be able to manage my entire financial services relationship. So I see this rebundling effect where we're seeing a more centralized financial relationship, and whereas in the past a deposit account was really the relationship starter, in a lot of respects, payments can be that relationship starter, and Apple Pay is a terrific example of that. Right in 2014. Apple Pay for POS launched. Then in 2016, it was embedded online. 2017 Apple Cash, P2P, still payments, 2019 Apple Card, still payments, and then 2023, we've got a savings account, right? So there's a clear path to utilize payments innovation to really drive a much bigger relationship.
I agree with you 100%, Regina. We have seen that Apple Pay drives decisioning quickly. It drives it fast. It also makes it easy on that experience. And right back to what you said, convenience. That generation is looking for as fast and as convenient as possible. And they don't want to have to go to multiple places to get their business done. The easier it is for them, the easier it is. They're going to continue to be loyal to their respective institutions. So why not build that bridge right away with those, prospective clients that are coming in the door, those members, and make them clients or members for life.
Mm-hmm. And I'd ask the question, Generation Z, how do they view payments? And, something that has come to my mind is that they don't, right? For them, payments should be invisible. Payments should be behind the scenes, anything that they don't need to know, rightfully so. Why even make me aware of it? If it just happens in the background, I'm happy. But how does brand strategy evolve in the fintech era when non-financial services firms own the experience and the bank or credit union is behind the scenes sort of powering the experience? It's a different ballgame.
You're 100% right. And that's where institutions have to start talking about, that business intelligence data that you were talking about. You can see where your clients or your members are shopping. You can see where they're the top merchants and retailers. And that's where you can get proactive with doing marketing campaigns, doing rewards, tying those to your debit or credit card. And it's going back to, how do you make that top of wallet? You want that card to be top of wallet, whether it's for Amazon purchases or other large retailers that you're constantly doing your business. So it's being agile enough to understand, these are where my clients or members are shopping. I need to make sure that my card is in those, that is easily stored, and that if they lose their card or if there's fraud on that card, that digital wallet comes right back into play. So there's no loss in time or transactions or loyalty to your institution.
And another payment type, Andrea, that I'd love your opinion on is buy now, pay later, right? This has been around for a little bit, but yes, a few things are happening now. There's a little bit of a risk involved, right? Especially in an economy that's a bit challenged, particularly younger consumers. Yes. Quite frankly, my son a few times got into trouble with it because he says, "Mom, I don't look at emails. They kept sending me emails. I need a better way." And then, of course, now buy now, pay later increasingly resembles a very high interest rate credit card.
Right.
So what are the risks and the opportunities here?
So this was really becoming more introduced during the pandemic because everyone was looking for, I'm going to be purchasing maybe a new gym set at home because I can't go to my gym, or I'm going to invest in a new TV and new surround sound for my home because I'm doing a lot of streaming. I'm watching a lot of Netflix and other movies. So people were looking for, how do I make sure I get my goods when I need them and I can make the payment? So buy now, pay later really introduced that. I like to call it that layaway option, where instead of layaway where you're doing multiple payments, you could say, okay, I'm just going to pay for it all right now. Or as long as I pay those payments every month, instead of paying $3,000 at once, maybe I'm paying $150 a month and I'm doing those payments every month. And that works for me. It's giving those flexibility and options to the consumer to say, you want to get all those goods and services delivered right away. You don't want to wait till you make 6 months of payments, which is what the layaway program used to be. They can get that consumer experience right away. They can give it delivered to their door. They can take advantage of it. And the online retailers really put a lot of marketing around it to say, let's go ahead and get that purchase for you. Here's, 5 or 6, retailers that offer this type of, solution for you. And you're right, though, Virginia, the risk comes in that it's going to send you those email notifications and say, okay, you have a payment due next month for this amount for this. It's basically like an installment loan, right? But the rates are much higher. So I think if you're going to offer that for your clients or your members, it can be a really great solution, but it shouldn't be a long-term strategy. So it's educating your client base about, what comes with those terms if they are to choose that. And if there's other options that you think would be better to offer them for those larger purchases, to pre-plan for those. Kind of goes back to that financial education, because we know folks are still using the buy now, pay later. I think what's different about it now, they're starting to see with the rates continuing to increase that it changes the payment amount, and that could be more expensive than if they would have, just used their institution's credit card or done something different within that transaction.
And there seems to be a play for community banks and credit unions here in providing more payment options, more payments flexibility to their customers and members. And if I'm hearing you correctly, Andrea, what you're saying is, you have to be careful, though, and manage the risk well, because if a customer or member gets burned by a buy now, pay later loan, then essentially they're going to hold the financial institution in some respect responsible for getting them into the situation in the first place.
Absolutely, because even though it's not the institution's fault that change that occurred, they're going to feel like, well, why didn't you educate me? If I had known you could offer me a short-term loan that I could pay, no prepayment penalties, and I could have still gotten, that TV that I wanted or the new gym set at home that I wanted, they might have made a different decision. But in that instant, when they wanted that Black Friday deal at that price, they decided to go ahead and take advantage of the buy now, pay later option, not realizing that could have an 18 or 19% APR that they weren't expecting that's what that payment will look like.
And what we're also seeing in the data is that increasingly buy now, pay later is being used to pay for things like groceries. And that was never the intent of that payment type in the beginning. So considering we were at $1 trillion in credit card transaction volume right now, and we've got student loans that are going to have to be repaid here in the not too distant future, there could still be some payment shifts that we see in the fall as we move into next year.
Absolutely. And it goes back to really always constantly educating both your members and your clients on what's changed in the financial services market, how you support and serve them, and what tools and strategies you have available to them. Because not everybody is in the space that you and I sit in, Virginia, so they're not aware of all the things that are changing with the rates, or if they have a variable rate, what that means if it's not a fixed term. Those are things we know because we've been in the space for some time. But the average consumer isn't necessarily paying attention to, the Fed just raised rates again. What does that mean for my variable loan or my variable line? They don't know what that means. And so it's our job as a financial institution providers to make sure that they're getting that information.
I really like that. Financial wellness, financial education, so important for the relationship with that customer or member in the long term. But then also that opportunity to wrap artificial intelligence around all of the behavioral data that we have on our customers and members. They're essentially telling us every single day what they need, what the risk is in their financial lives. And so it's incumbent, I think, upon the industry to really be in dialogue with them about how we can solve problems. Let me just switch gears really quickly, because we've talked about so many different payment types, Andrea. I want to talk a little bit about giving consumers access to the payment instrument in the first place, right? We have to give consumers the ability to actually make these payments. Where does technology take digital issuance and digital activation and access in the next 5 years?
So one of the things I'm always curious when I talk to any financial institution is I always ask, are you offering these solutions today? And not always I can be surprised pretty frequently when people say, no, I'm not offering that. Why should I offer that? I'm like, the question shouldn't be why should, it should be why shouldn't you? Because as you said earlier, it's table stakes. That's like expectation. The large institutions have been putting that on the table for quite some time. You don't want to take any chance that if your institution doesn't digital issuance, that consumer is not able to transact their business that they're normally used to doing, because that gives them an opportunity at that point. If they're told, no, I'm sorry, we don't offer that, what do you think that person's going to do? If they're a younger generation, they're going to go find the next person or the next institution that can do that for them right away. And so that gives them a chance to shop around and see what other institutions are offering and what's more flexible for their needs. So I say making sure that you offer those solutions, because those are considered table stakes today. Offering digital issuance cards, offering digital wallets, having contactless open. Doesn't mean that everyone may take advantage of it, but it goes back to doing the data mining and understanding and knowing your customer and knowing what's important to them. You're going to see based on the transactions, because you can see those transaction types in the reporting to see how that transaction is going through. You want to make sure that you offer as many things that you can that are going to be relevant, top of wallet. They're going to increase your interchange income, and they're also going to keep you relevant as an institution long term.
Consumers are getting exposed to better and better payments experiences. That experience, of course, is not just about making payments. It's about having access to the payments in the first place. The bar that they're going to hold every bank and credit union to just got higher. And that's really where the challenge for our industry is. No matter the size of the institution, it's clear, payments are a relationship anchor in a positive sense, not, dragging the relationship down, but supporting the relationship, building the relationship, keeping the consumer the customer, the member engaged, active, growing the relationship. Do you have any final thoughts, Andrea, on where payments is going to take us over the next 3 to 5 years?
I think that payments is going to continue to grow. I think it's going to be channels that we least expect. So I think it's, innovations that are going to come that could be through things that we didn't even think were going to happen. In Virginia, you talked about it earlier about having digital payments within a car. 10 years ago, did we even think that would be a conversation starter? But now, even now when you plug your phone into, you use that car charger in those cars that have that technology, Apple Pay comes up right away. The nearest location for restaurants comes up. That data is already coming back and going back to those car manufacturers, right? They're getting all of our information. They're seeing who I am, what I'm doing, where I'm at. So we have to get really creative about making sure we understand where our consumers are, meeting them where they are, where they're shopping, what they're doing. And what really kind of comes back to leveraging data analytics. I think we've talked about that over the years. I think certain organizations have gotten folks that are data analysts within their organization, whether they're small or large. Those are the ones that are going to come up with those new innovation thoughts and strategies. They're also going to be the ones that probably are the early adopters for new technology and new channels or rails we may not have even thought of yet, because they're seeing it within the data mining and they're saying, wait a minute, does my online mobile banking provider provide this? Am I able to get this in my strategy today? If I'm not, is this something that my partner or provider is going to have in the near future? And near future anymore isn't the next 18 to 24 months. It's usually 6 months or less. That's becoming kind of the new expectation that, yes, you can have a 12-month roadmap, but they want to know, what have you delivered to me recently? And what can I consume in my own API experience? It's going to make sure I get exactly what my consumers are looking for.
Shorter innovation cycles.
Absolutely.
So we've been around the payments world in about 30 minutes. This has been a really terrific conversation, and I can't thank you enough, Andrea, for sharing your experience and your perspectives. I've really enjoyed our conversation. One of my big takeaways from all of this is, to really leverage data, like you said, leveraging data, leveraging the analytics, utilizing artificial intelligence to demonstrate to the customer, to the member, that you know them, that you can anticipate their needs. It's not so much about the chatbot landing on a customer's or member's phone and saying, hey, I'd really like to sell you something. It's landing on a customer's phone and saying, your payment is coming up. You have been habitually late. Let me help you avoid that late payment. Let me help you shift making the payment from bill pay conceivably to a brand new payment type utilizing FedNow, possibly paying something through Zelle as opposed to sending a check. That's real value for a customer or member.
Absolutely, Virginia, you're 100% right. It's that knowing who I am, knowing how you're going to serve me. It's the flexibility, it's the seamlessness, it's the frictionless experience in everything that we do. So you don't have to be a large institution to provide that. You just need to have that intelligence behind it to say, how am I going to deliver it? Is it going to be through myself, our institution, or are we going to leverage our providers and make sure that our clients or our members get that experience every single time? Because flexibility is going to be key.
Terrific closing point, Andrea. Thank you so much. And to all of our listeners, having an enterprise payment strategy is a powerful competitive differentiator. If you would like to continue this conversation one-on-one, just let us know. And in the meantime, have a great rest of your day. Thank you, Andrea.
Thank you so much, Virginia. Thank you, everyone.